Brilliant. I think we're on.
Hi, everyone. This is Rohit from Life's Mastery, and today I'm excited to have Gaurav Jain, who's a partner at Afore Capital, which is a $124 million early stage VC firm. He was the founding product manager at Android Nexus, and he was the investor at Founder Collective, which had invested into cruise automation, Firebase, and other companies. He had done his software engineering from University of Waterloo, and had done his MBA from his MBA from Harvard Business School. Welcome to the show, Gaurav.
Thank you so much for having me. It's a pleasure.
Yeah, I mean, you've had an interesting career. You were one of the the founding product managers at Android Nexus, and you got into the venture world. What got you interested to be in this world of startups and the VC world?
Yeah, growing up, I grew up in a small town in India, and my dad was an entrepreneur running a very small business, but it wasn't a startup in the way we define startups these days. It was a manufacturing business, but so I was exposed to the world of business, I guess, early on. But frankly, when I went to University of Waterloo for software engineering, I just wanted to be a software engineer. I wanted to write code. I loved math and I loved computers, and I felt like it was what I wanted to do for the rest of my career. And believe it or not, when I started at Waterloo in 2003, Microsoft was like the company you wanted to work at. Of course, the world changed quite quickly. It became Google, and then Facebook, and then now it's startups are where you want to be, as early as possible in your career. But anyway, I got into startups because I'd worked at different places, including Research in Motion, now called BlackBerry, back when it was still a cool company in the early 2000s. As the company started in Waterloo, or at University of Waterloo many years ago, so there was the rite of passage for engineers coming out of Waterloo at the time. So I did an internship there. I worked at Amazon in 2005, working on search technology, did a whole bunch of different stints, but really realized a key thing, which was I didn't want a job right away. I wanted to start something, right? There was just so much innovation happening, so much flux. I'd worked at BlackBerry, and of course, smartphones were taking off, and the internet, and so on and so forth. Saw with e-commerce with Amazon. So with a couple of buddies of mine from University of Waterloo, we ended up starting a company in 2007. And the idea was pretty simple. We BlackBerry at the time was selling like hotcakes, and these executives and customers wanted to consume more and more rich media content on their phones beyond just email and calendar and so on and so forth. So we basically went to media companies like Time Magazine, CNN Money, and said, hey, we can build your smartphone apps for BlackBerry, and then eventually iOS and Android. And that business took off, right place, right time. And that was also my first exposure to venture capital. So it was a venture-backed company. We raised an angel round of $600,000 in summer of 2008. We raised a Series A in 2009. So really got to see what it's like to be on the other side. Where as an investor, you get to invest in a lot of different companies and get to see them from the ground up. Anyway, that experience then brought me to the Android team. I was an early product manager, as you talked about, but the experience with Polar, that was the name of the company. That was my exposure both to the world of startups, but also venture capital.
Right. Yeah. I mean, I want to talk more about Polar Mobile. When you looked at the idea of building Polar Mobile, how did you structure your thinking on how what is the problem that you want to solve? Did you look at the market or the idea? What really got you into thinking that you wanted to start solving this problem?
Yeah, for sure. I mean, look, we really started off with the micro, not the macro. And this is what I tell founders, right? Don't look at McKinsey studies on, TAM, or don't read TechCrunch and then try to come up with an idea. I mean, there's some companies that are founders, I'm sure, have done it successfully, but I think you want to start with the micro, which is like a problem that you can solve, or an opportunity that you're excited about, that you believe if that product existed, there would be people that would find value in it, and then maybe there's a big market there. And of course, you want some conviction that if you build this, that there are a non-trivial number of users and that there's adjacencies in the market, but really start off with something small. So in our case, it was, we were carrying BlackBerries, and if you tried to read a magazine or newspaper or watch a video, it was a pretty terrible experience, because BlackBerry always saw themselves as an enterprise product, right? An enterprise, like, you don't want to be watching a video that's considered frivolous, right? So they never invested much in the developer platform and an app store. The browser experience really sucked. So we said, hey, what if we build a native app, which I know today sounds like obvious, but 10 plus 12 years ago, native apps weren't a thing before Apple launched the App Store. So let's build native apps that are custom to these different properties, and it'll be fully branded, and it'll be their content. And if you're a subscriber, you can now access this content on your phone in a way that's a lot easier to digest. It's a lot more interactive. So that was sort of the idea. That was a light bulb moment, which is like, okay, yeah, I want to read CNN. I want to read Time Magazine on my BlackBerry. Experience today sucks. We think we can do better. Let's go build it. That was it. And of course, over time, it evolves. And that's what I look for today as well as an investor, is like helping you understand, like at a micro level, what is a problem that's exciting you so much. We can talk about the market and stuff, but frankly, I think thinking about market this early, it's completely the wrong exercise.
Interesting. And you after Apple Mobile, you went on to work for Android. How did that opportunity come in, and what got you excited to work in Android at that time?
Yeah, totally. So, I worked at BlackBerry. I started a company in the smartphone space, which then exposed me to iOS, and then Android was really just starting to kind of grow at that time. So I'd been, in mobile and smartphones for a while, and I was really passionate about it. Right, as a user myself, I kind of really saw not just an enterprise, which obviously, BlackBerry was really taking off, but I think the consumer world, that our devices will go from, a Motorola Razr or like a handheld phone to eventually be smartphones, right? And of course, the iPhone launched in 2007, and you really saw kind of what a touchscreen could do, and putting consumers front and center. And then of course the App Store launched in 2008, and you really saw this acceleration in adoption, right, of smartphones on the consumer side. So I knew that was kind of the rising tide. That's where the future was going to be. But Apple, historically has been a fairly expensive product, right, for a whole host of reasons. So which works fine in the U.S., but you look at it. I grew up in India, in a small town in India. You can't afford $1,000 device. That's a lot of money. So I thought Android's strategy was very interesting, which is bring smartphone and web-enabled phones to like everybody else that's not the 1%, if you may, of the world, right? Which is obviously a very large market. So I was, Google reached out. Google wanted to really double down on Android, and given my experience with BlackBerry and Polar, they wanted to really bring in folks that have been spending time in the space to help grow market share. So when I joined Android, there were less than a total of 1 million users on Android, and by the time I left, we were getting about 1 million new users a day. So really just saw the incredible growth of the Android platform, which I think was sort of this thesis coming to fruition that I talk about, which is there's a lot of people that would love to have a smartphone, can't afford an iPhone, but want similar functionality. And there's a whole bunch of other stuff with the Android strategies that worked out well, but I really did believe in sort of where the future was going.
Right. And what were some of the key learnings while building the product? You talked about, you very early into the product where there were just 1 million users. Yeah, and what were some of the processes and some of the learnings you had while you were building the product, and the user base had gone to 1 million users per day.
Yeah, definitely a bunch of different learnings. I think one of the learnings that comes to mind is the fact that Android did a good job at having a community that was very excited about it, passionate about Android early on. And that was more the developer community, the more geeky community, if you may, which absolutely despised iOS because it's such a closed ecosystem. It's like really hard to develop on it, really hard to like work with it, versus Android took a very different approach, which means like folks that are tinkerers like absolutely love the platform. That's where it started, which in some ways that was the initial branding of Android, was like, oh, this is this open source, geeky operating system, not gonna, hit mainstream. But of course we took that and eventually kind of broadened the target market, right? Found concentric circles of markets that were adjacent to where we started. But I think it's really important to focus on a small but passionate community that loves your product. Don't try to boil the ocean. Don't try to be everything to everybody. It's just really, really hard. Out of the gate, start small and then eventually grow from there, and learn from the first community that's willing to give you feedback, willing to iterate with you, and then eventually you kind of scale from there. I think that's one. I think second is the power of go-to-market and adoption. Building a great product is only half the story. You've got to get it in the hands of users, right? And you can't just build a great product, throw it over the fence, and hope they come. Sometimes it works, most times it doesn't. You have to be just as thoughtful and strategic about adoption. And in Android's case, that was about partnerships, right? We knew that we didn't want to build the hardware ourselves. Instead, we wanted to partner with the hardware manufacturers like LG, Samsung, HTC, and so on and so forth, and empower them to take Android and build great experiences for their customers. And that worked really well. And of course, we aligned our incentives with theirs because they didn't necessarily want to build a smartphone operating system because it's very expensive to build an operating system, but also the developer community is very hard to attract, right? And developers didn't want to build for Samsung, HTC, LG, and then iOS. That would just be way too much fragmentation. So we saw there's an opportunity to say, okay, what if we build a developer ecosystem, the Google Play Store, right, and standardize the APIs and the SDK, and then but leave enough for our partners to customize. So Samsung phone, Android phone doesn't look like the HTC phone or the LG phone because they can customize the UI. So it's this perfect balance of you get a bunch off the shelf, but then you can customize it enough to make it yours. And that worked really well, and of course helped us get a lot of adoption. And then I think look, Android, it feels like it was an overnight success story. And look, a bunch of years of work had been put in, frankly, in Android even before I joined. And then of course, when I joined in 2009, that's like 12 years ago. So a lot has gone into it. It takes a lot of time. So you've got to be persistent. You've got to there were ups and downs along the way. It wasn't always up and to the right. It never is. But if you're willing to put in the time, you're diligent, you have to, you're thinking about from the first principles of perspective, eventually it will work out.
No, I think sounds like a great story. It's once in a lifetime story to work in such a high growth company. And you moved on to a founder collective, and you got your first taste into venture capital. What were some of your learnings before you started your own VC fund, or what were your learnings with founder collective?
Yeah, there's a bunch of learnings, right? One, I love investing super early, right? I obviously was a founder before. It's a venture-backed company, and when I left Android, I didn't want to start something again. I wanted to instead work with a bunch of different companies and help them from kind of the ground floor. And joining a fund like Founder Collective was a perfect fit. And there's a bunch of learnings. One was that you have to be very thoughtful around capital. Like you don't want to overcapitalize the company, right? Especially these days, I think it's very, very much relevant because there's so much capital in the system. It's relatively easy to raise big rounds, but I think this focus on first principles, this focus on putting the customer first, focus on really solving real problems, and capital is a means to an end and not end in and of itself, I think was really steeped into me at Founder Collective. I think aligning your incentives with the founders, but also doing the right thing by founders. It's easy to say you're founder friendly. Everybody says that because that's what founders want to hear. But truly, when you're on the opposite side for whatever reason, right? Which happens sometimes, right? Because you are negotiating, on terms or exits and so on and so forth. But really, ultimately being on the side of the founder, even if that means sometimes under optimizing for what's best for you. I think that's what truly makes you founder friendly. And I thought the team at Founder Collective very much believed in that. So that was great. I think also just, being a good human, right? Ultimately, this is a people business, and there's a human behind every company and behind every product. And I think just not forgetting that and being empathetic to that and being helpful in the right way. Like a lot of my time these days is being like a corporate coach or like a therapist, if you may, for our founders, because it's not easy to build a business, right? It's an emotional roller coaster. So I think just being there for our founders, having been a founder myself, and everybody at Founder Collective, hence the name, had been a founder themselves, really, understanding what it's like to be on the side and bringing that to the table, were some of the learnings that I had from my experience there.
I think that's super interesting because you've been an operator, a founder, and an investor. I wanted to understand, what was the thesis behind Afore venture capital? Are you, state, sector, and geography agnostic now?
Yeah, we're sector agnostic. We're geography agnostic to a large extent. We are very stage focused. So the thesis behind Afore, I was having a great run at Founder Collective. You mentioned I invested in cruise automation, I invested in Airtable, or was involved in the Airtable investment, invested in Firebase and many other great companies, Secure, having a great run. But one of the things I noticed was how the goalposts were shifting for founders, right? So if you were two founders just getting started, looking to raise your first million and a half, so you can hire some engineers, so you can get some traction, seed funds weren't investing in those rounds, right? Very often seed funds will tell you, well, that's great, but you go raise $1 million friends and family round and get some traction, build some product and come back to us. And most founders would be like, well, I don't have such wealthy friends and family who can give me $1 million. So like, where do I thought VCs were supposed to do that. And so the light bulb went off as a founder myself and said, okay, I think there's a problem here that we can solve. I think there's a gap in the market we can solve. So our focus at Afore is very much in a stage which is being called pre-seed, right? And the idea is simple, which is it's just a founding team usually. It's pre-product market fit, most times pre-traction, pre any revenue, pre-customers, sometimes even pre-product, right? Maybe they have a prototype, right? And that's fine. Like we're very comfortable going in very early when like friends and family would have invested or angels would have invested, but we can come in as an institutional fund, right? We can write a $750K, $1 million check, $1.5 million check to really get you into business, get you started, right? Because we believe it takes about $1.5 million in most geographies to get to a meaningful inflection point. $500,000, $250K, not enough. $5 million, too much, right? You need that right amount to be able to get something going, and then you can raise more capital at a much higher valuation. And that is a stage we are exclusively focused on. But we've invested in companies in B2B, SaaS, and B2C, e-commerce, fintech, edtech, so on and so forth. And most of our investments are obviously a software heavy, right? Sometimes hardware, but mostly software, mostly internet based. And then geography wise, mostly US. But my family lives in Canada, so I've done a bunch of stuff in Canada. And then outside of the North America, I've invested in Latin America, I've invested in Sub-Saharan Africa, I've invested in India. So open to other geographies too, but that's going to be few and far between just because we're not on the ground there. I can't help you as much, but we're in the business of exceptions. So on an exceptional basis, would totally invest outside of the US as well.
And you mentioned that you look at sometimes pre-seed, pre-product market fit at times. How do you analyze the trade-off people, product, and market, especially when are you focusing a lot on the team to figure out the problem, or do you also look at how attractive the market is?
Yeah, a lot of investors believe that like market's very important, right? And that the market gotta be large. And I think Warren Buffett said, right, if it's a big market, mediocre team or something, like the market wins, something along those lines, which I think maybe is true later stage, but at our stage, I think market is a completely useless metric to look at, in my opinion, right? Because the best companies will expand markets in ways you can't even imagine, right? Like I think when Uber started, the whole taxi market, like in San Francisco, was like, I don't know, a few $1 million at best. Like it was tiny. And like Uber does like magnitudes more business today in San Francisco than the entire taxi market back in the day. So if you looked at Uber as a taxi company, like you would have completely missed the real opportunity, right? And I can say the same thing for so many other companies. Like look at Google, right? When they started, the online advertising market was tiny, but you've got to look at Google as much more than an online advertising company, or even search for that matter. So the best companies just expand markets or distort markets at the very least in ways that you can't even imagine. So you don't want to look at market at this stage. You should have some point of view on where this market can evolve to, or can does this market have an appetite, for a large company? But I would discount that market piece very, very heavily. So then it comes down to people and product. And at our stage, like the product is still pretty early, right? It's not really built out. So ultimately at our stage, it does come down a lot to people, right? And what does that mean exactly? It's not about where they went to school. It's not about necessarily how smart they are or SE2 scores. None of that stuff matters. It's how thoughtful they are about the problem they're solving, how authentic they are about that problem they're solving, right? Being able to show that trajectory of like, look, maybe I was working at this company, maybe I was working at like, Twilio or Segment first, and I saw this problem and it wasn't part of that mothership, so I'm leaving to start something. Like that's great, right? Because you've been thinking about this for a while, you've been working on this for a while in some shape or form, versus, oh, I just read a TechCrunch article this morning and now I'm like working on this startup. That's not very authentic to me, right? And then just how much depth you have in the questions I ask. Like so much of my diligence is like just keep asking you, so what, or what's next, and then I want to see you can go to like fifth, sixth, seventh level of detail and still have answers, because you've just been thinking about this a lot. So for me at this stage, again, it's just a lot of it comes down to, is this the right team to back to go after this problem, right? And I really look at the first 12 months or so. Like, can this company get to first base? Is there something here that'll get them, some initial traction? And then if I'm backing the right team, they'll go from strength to strength, right? They'll figure out what's the next problem to solve, right? What are the adjacencies? What other market can we go after? And that's fine. But I've got to believe this is the right team to get us at least, to first base.
Interesting. And you said markets may not matter, but at a pre-seed stage, how do you approach market sizing, or even later on, when you look at follow-up rounds, how do you approach market sizing?
Yeah, generally you have a point of view, right? So for example, I invested in a company called Modern Health, right, in the mental health space, right? But they're going after the B2B channels, selling it as a benefit to employers to say, hey, your employees should be accessing mental health support because, all of us have some kind of emotional stress, whatever the case might be. But when I invested, like, mental health was a small category, and certainly B2B mental health as a benefit was like a tiny category. So it wasn't so much about snapshot of market size today, but again, it's just a point of view on, I think the trend lines are in this right direction. I believe, and this is where we get it wrong too, right? A lot. But I believe that mental health would keep growing as a market because I think it's a systemic problem. It is something that's stigmatized. So it's a much larger problem than meets the eye because people are sort of, not talking about it or not accessing mental health help. But the moment we make it affordable and accessible, like, the market will expand suddenly, right? I think that's the point of view you've got to have. And then, of course, is this the right team to unlock that latent potential and so on and so forth? Is this the right product and go to market? Like, all of those questions you have to ask. But I think we're trying to, so basically we're approaching market sizing is less about like, what's the size today, but what can it be in 5 to 10 years, right? And can this, ideally, this team becomes a category leader, right? Going back to my Uber example, like, if you look at Uber as like on-demand company or gig worker, like, none of those things were interesting markets. Travel, taxis, none of that stuff was interesting. But you've got to look at it as like, okay, I think if these guys do something right, like, that'll become a category in and of itself. And today, of course, you see Uber for X everywhere, right? Like, those are your best companies, and that's sort of how you want to think about market sizing.
Interesting. And how do you look at portfolio construction, since you invest into a company, and what do you think is the right level of diversification?
Yeah, we really think of portfolio construction as like, we want to be able to spend a meaningful amount of time with the founders in that sort of 0 to 1 phase, right? When they're going from very early, where we invest typically, to like product market fit. I want to be the most like active board member, the most active investor, most active advisor you will ever have in the history of your company. And to be able to do that, you just can't take on too many projects, right? Too many companies. So it's probably half a dozen or so, maybe at any one point in time. So we think of investing in about 10 to 15 companies between my co-founder and I every year, right? So that gives us about that many companies that we support. And then, of course, every 12 to 18 months, companies are raising more capital, and then they sort of graduate past our stage, and we're not spending as much time with them. So we're very focused on these companies in that pre-seed to Series A phase, if you may. So, you sort of take that, and you say venture capital funds are typically 3-year investment periods. So you're doing about, 30 to 40 investments out of a fund. Our typical check size, let's say, is about, $750 get $1 million. So you're looking at about, let's say, 30 million, 35 million in investments initially, reserve half the fund for follow on. And sort of that's kind of, how our fund math is built, and fund size is sort of backed into. And, every investment we make is very high conviction. So we're not writing call options. We're not, placing these kind of, small checks in lots of companies, see which ones take off, and then kind of double down. That's not our game. We're very focused on, like, I understand you're very early. I understand there's a lot of risk, but I still have a lot of conviction that this is going to be huge, and I'm willing to like put in my dollars and my time behind that. And it's a very concentrated, strategy, and it is risky for sure. But again, when you get it right, it just really moves the dial for the fund, and that's sort of how we've talked about portfolio construction.
Got it. And when you started Afore Venture Capital, keeping up to the theme of the pod culture, lifestyle mastery, how did you look at the values for your fund, and what are some of the values that you thought about when you build Afore Venture Capital?
Yeah. You know, interestingly, we are founders ourselves again, right? Of a
Yeah.
fund this time, not a company, but we have to fundraise just like our founders every, in our case, every 3 years or so. We have to build a firm from scratch, build a business from scratch. We have customers, and our customers are our portfolio founders. We have an offering and a product that we sell to them, and we try to compete against other venture capital funds to win those deals. So in a lot of ways, it's a business, and we're founders ourselves. So we one of our key values is to do to founders what we would like to be done to ourselves. So what that means is being respectful in the diligence process, being quick, and a quick no is better than a slow maybe, right? And when we do invest, like really following through into our commitment, and really holding a high bar internally and externally, being very transparent and communication. Like we tell our founders, like, look, if you just want a pat on the back and just tell you that you're doing great, and keep the feedback, the hard feedback to ourselves, we're not your right investors. But instead, if you want us to tell you what we're thinking, with the understanding that like we could be totally wrong, so just listen to us, but ultimately do what you think is right because you are the CEO, you are the founder. Like that, then we are your people. Those are some of the values that we really abide by. Is the founders we invest in. We never forget that even though we might be investing in their companies, we might have some a board, like whatever governance and so on. Like none of that stuff matters. Ultimately, these are people, these are founders, just like we are. So I think that's very important to us. I think aligning our incentives very much with those of the founders. Always trying to be on the same side of the table with them, I think is important to us, because we're trying to build a firm that we would have raised from as when we were founders, or we would want to raise from even ourselves now that we're investors ourselves, we're founders ourselves.
Got it. And during these times, how do you advise your founders on approaching talent market? Since COVID had an inflection period where you could get the best of talent and they can work remotely. But what advice would you give to founders on how to acquire the best of talent?
Yeah, the last 12, 18 months have been very interesting on the talent side, right? When COVID initially hit, obviously a lot of layoffs, and it felt like, wow, like this is the hiring managers kind of market, and the bid has flipped by the end of the year, and it was becoming harder and harder to find talent. And right now we're probably at the peak of just how scarce it is to find great talent. So it is interesting, a lot of flux obviously in the market. We're seeing a few different things to our founders. Obviously, still keep the bar high, right? You don't want to compromise in talent, because these cycles come and go. But I think if you're trying to build a company for multiple decades, right, you see past that, and you've got to just keep the bar very high, because it is ultimately still a people business. There's still a human being behind that product, behind that code that's building this stuff. So you want to keep that bar high, both in terms of culture fit, but also competence. A lot of, you have to be really smart and thoughtful around where to find talent, how to approach them, how to sell them on the value prop. And it's not just about cash and equity anymore. There's a lot more that the best talent is looking for, whether that's flexibility, as you alluded to, on being able to work from anywhere, whether that's other benefits. Obviously, one of our companies, Modern Health, that I talked about, sells, is selling mental health benefit as one of those tenants. But there's a whole bunch of other things that the best employees are looking for, and you've got to meet them there. Because the amazing part is, especially building a software startup, best people just bring in so much leverage, right? They create so much value that they're totally worth it, and hence you really want to prioritize that. But at the same time, like, there's just a lot of capital also getting thrown around. Again, telling founders to push back on the temptation to just raise the biggest round at the highest price, right? It is very tempting when you see your friends raise mega rounds and unicorns and decacorns and all that stuff. And look, you got to be aggressive. You got to be ambitious. You absolutely have to. There's a window of opportunity, and if you don't take it, somebody else will, right? It's a competitive world out there. And in some ways, getting more competitive, because now you can start a company anywhere in the world as long as you have access to the internet. So you've got to be ambitious and aggressive, but at the same time, I do think first principles matter. I do think building a sustainable business is more important than just a quick hit. So anyway, our advice is also constantly evolving as the market keeps changing around us. Obviously, we're living in a very much a bull market with a lot of money, but that may change, and hence will our advice.
All right. Gaurav, I quickly want to do the top three. What's your favorite business book?
There's a lot of business books that have had a lot of impact on me, but I think the top of the list still is I was very privileged to take a class from Clay Christensen when I was in business school, and he's obviously the godfather of the theories of disruption and innovator's dilemma, and his books around that, and also just his books around personal life and how to spend your time and sort of focusing on something 100% of the time versus 99% of the time. Just he's had a lot of impact on me, so I'd say anything he's written has been my favorite.
We'll put that in the show notes. And if you could go back in time when you started Afore venture capital, what is the one thing you would have focused on or done anything differently?
I think we might have invested more on some of the resources around helping the founders, frankly. More like my co-founder and I did a lot of the work, whether it came to recruiting, helping recruit the first few engineers, the first few employees, helping fundraise for Series A, helping with go to market, getting your first few users. Like a lot of that work was done by us, which was, I think, good because like A, we enjoyed, and B, we were able to learn on what to productize. But we're at a stage in Afore's journey where we're looking to scale the team to really operationalize some of those things that we can bring to the table for our founders to go from that 0 to 1 journey, right? And I think to be able to create that impact at scale, and maybe if I could have pulled the timeline in a little bit, that would have been great. But we're certainly at that inflection point where we're making those investments, and we're already starting to see some results. So, for example, we launched this program recently called the All Stars program, where we want to make it easy for the best talent to join the best companies at the ground floor, right? I get hit up all the time to say, hey, like, I'm looking to leave this company. Like, what's the next greatest company I should join? What's your favorite company in the portfolio? And I end up making these ad hoc connections, which is fine. But we said, hey, I think there's a better, more efficient way to do this. So what we're going to do through this All Stars program, and I'd love if anybody in the audience is interested in this idea, is hand select 10, 20 folks, right, that are looking to join, let's say first head of sales, first, engineer, so on and so forth. These companies have like 5 or 6 founders come in and pitch you for 5 minutes each on why you should join their company. So sort of a reverse hiring process. So the founders will pitch you on joining, and if you like the pitch, then you can email them after the fact and say, hey, look, I was interested, can we chat? And then you can take the process from there. So, we've launched a program like that, which obviously for portfolio founders is great because now they get to be in front of hand-selected talent, in a more efficient manner as well. So there's a whole bunch of tools like that and programs like that we're going to be rolling out that help our portfolio founders, but also just help the broader community.
Interesting, because I've been part of OnDeck podcast fellowship, and they did something very similar where they invited founders to pitch and pitch for talent. So something very similar is what Maven is also doing. So very
That's amazing. Yeah, no, and I think it makes a lot of sense because it's such a win-win for everybody all around, and it's just time is of the essence. So if you can be efficient and if you can do some filtering for folks, I think it's a huge value creator.
Got it. And do you have any favorite online tool, for example, Gmail, Slack, Zoom?
Yeah, it's funny you said this. Calendly has been like one of my favorite tools, which is crazy because it's such a simple tool, and you'd imagine like Gmail should have built this like 10 years ago. But it's been amazing. Like I used to have an EA, and she was amazing, except like the response time to delays were just like, I mean, humans, right? It just takes us time to get to emails. But with Calendly, I find I get introduced to a founder in the morning, and by the late afternoon, I'm already on a call with them because I send them Calendly link right away. They book something, and like we hop on a phone. So I love the shorter cycle time because we look to move very fast when we see something good. And I think Calendly has really helped me achieve that. And it's not a portfolio company, so I'm not selling my book. I wish it was.
Yeah. Now, Calendly has also been one of my favorite products along with Zoom. Really saved me in the last couple of years, especially.
Zoom obviously goes without saying. I mean, I've been working from home for over a year now, and I don't think I could have done it, frankly, if it wasn't for Zoom. I still sometimes get invited to Google Hangout meetings or WebEx or something. It's just like, it's a horrendous experience. And I hate to say that because I'm an ex-Googler and like a shareholder, so I wish the product was better, but Zoom is just a class of its own.
Yeah, no, absolutely. And Gaurav, what is the best way people can reach out to you and know more about Afore?
Yeah, we want to be very accessible. So look at the absolute like easiest way, of course, is just email me. It's my first name, Gaurav at afore.vc, afore.vc. But I will say, like, I get a lot of emails. So if you can find somebody in our mutual network on LinkedIn that perhaps knows both of us and can like give me some color on how they know you, and maybe if they know something about your startup, it just helps me prioritize my day. And like we see with over 3,000 new companies every year, we only get to invest in 10 to 15. So I have to very quickly whittle down the funnel to figure out where to spend time. So again, I don't want to make it hard to reach me. Please email me if nothing else, because I absolutely, and I read every email and I'll get back to you if it could be a fit for us. But if you could just help me prioritize, that'd be incredibly helpful.
We'll put up the email in the show notes. Gaurav, thank you so much for taking the time and speaking to us. I really
Thank
enjoyed
you
my
so
time.
much. This was a lot of fun. Thanks for reaching out.